Welcome to Stock Talk with Nico Criticos. Today we're going to do some stock analysis for Williams Sonoma, ticker WSM, because the stock is up over 11% today. I'm not sure why. I can't find too much news on this, but the stock is up over 11%. The market cap is $10 billion now. And if you don't know, this company owns several different brands such as Pottery Barn and Williams Sonoma. So we're going to do some stock analysis to find out if this is a good investment or not. The first thing we're going to check out is revenue. And revenue has been very consistent for a long period of time. We're looking at anywhere from about 8 to 10% growth on average, with them doing $8.6 billion last year. So that will get a check on my list. Then as for net income, it's a pretty similar story. For some reason, there was this giant jump here in the last 2 years that put them at over $1 billion of net income when usually they were doing like 300 or 400 million. So I'm not sure why that is, but over the long run, they were growing at about 16% per year. So that will also get a check, even though the last 2 years have been sort of an outlier. As for price to earnings, right now it is a 9.7. Keep in mind, this is trailing though, and this is going to be important for this example, because if we look at the chart here, it's trading at 9 times trailing earnings, but that is because their earnings were $16.15 last year, and this year is expected to come down a little bit, down to 14. So it's actually trading at about 11 times. But even with factoring that in, if they let's say it comes down to $14 of EPS for this year, then we're looking at a PE of 11, which is still incredibly cheap relative to where it's been at for the last 10 or 12 years. So that will get a check. Then we move on to, is the company innovative? I would say not the most innovative company, but I think they're innovative for the type of space and industry they're in. I would say they are. They put some emphasis on utilizing digital first instead of just selling through digital platforms. So I think that's good. I'd say that's probably one of the best things you can do for a company like this. The market share is strong, roughly 10%. Now there's couple different things here. This number is sometimes hard to pinpoint because it depends what type of industry you're talking about and who the competitors are. So in their presentation, they're saying that their total addressable market is $80 billion. Now, the other interesting thing that I like to see here is like this list of, see, they say digital first, not digital only. These are e-commerce retailers in the United States. They're number 22. So they're not super high up on the list, but that's still really good, especially compared to some of these other companies like Ulta Beauty or GameStop. They're much higher. And then, they're competing with Amazon, Walmart, Apple, Home Depot, Target. But they're saying their total addressable market is about 80 billion. That's why I put a market share of roughly 10%. But when you look it up, it's the one statistic I found is that their market share is actually 37%, because if you look at just online home furnishing sales, then they're accounting for a much larger percentage of the sales. So it depends how you measure it. But overall, it's still strong market share. And not only that, but they're also outgrowing the industry. They said the industry grew 1% last year as to where they grew 5%. So that's good. Now, this is probably my favorite one. This is one of the most important things I always look for. And this is one of the best numbers I've ever seen any company do. There are not many companies that get as high as 50% return on invested capital. And even now, they don't do that every year. That it's really been the last 2 years. So something must have happened the last 2 years. I don't know what happened. But even on a bad year, even during the pandemic year, they did 19%. That's really good. And then for the other years, it's anywhere between 25 to 35%, which is also really good, better than a lot of companies. So that really sells me on this stock. That's what makes me want to buy it. But the valuation needs to be right. Now, and how we saw, the valuation is not bad. I mean, the stock could easily be trading at 15 times earnings or something. So 11 times is on the cheaper side. With that being said, the stock is up not only over 11% today, but it's up 30% in the last 3 months. So I kind of wish I would have found this when it was like $120 or something. But we'll see. That's why I bought a share today, just to keep an eye on it. And then I would like to make this into a position, as long as if this comes down to a healthier spot, if this falls back down like 10% or 15%, then I'd be more comfortable. But who knows? Maybe I could very well see the stock just keep going, and maybe it comes back up to $200. That's also a possibility. So we'll see what happens with that. Growing equity, yes. Their equity is growing, not by a giant amount, but it's still fairly consistent. We're looking at 1.2 billion 3 years ago. Now we're up to about 1.6. Okay, so that's pretty good. Equity is now this one is funny because this one barely, just today, since their stock is $10 billion, 15% would be 1.5, right? They're at 1.6. So they just made it. So I'll give that a check. This next chart was also very good, very nice to see. We're looking at, what, maybe 10, 15, 20 years ago, they had 120 million shares. Now they only have 69 million. So they've nearly cut their share count in half in the last 20 years. That's really good. And then they're super consistent with it. They're dropping it by, 3-4% every year. That's really good. That's going to help the stock price go higher. So I like to see that as well. And we're going to get to it. They're also paying a dividend. So they're rewarding shareholders in a lot of ways. It's good when they can buy back shares to get share appreciation as well as paying a good dividend. Now, assets minus liability, or assets are not 2x liabilities. Profit margin also fairly strong. 13% is good. Cash receivables are they're like 600 million or so. And although that's not more than what they did the last 2 years of net income, it's more than what they normally did. Because remember, for years and years, they were only doing $300 or $400 million. Then it creeped up to 600 or 700, then it creeped up to over $1 billion. So I don't know what's going to happen. That's why it says earnings are going to come down a little bit. So maybe they'll probably do under $1 billion, but really on average, their cash and receivables are more than the income. Healthy dividend, yes, we're looking for consistency and a strong payout ratio. Payout ratio of only 23%. That's really good. 2.5% dividend yield is not anything crazy. It's not a lot, especially in today's market, but it's still something, and the payout ratio is what's more important. And the consistency is important, and how much they're growing the dividend by. So they're growing it at 15, 16% a year. That's really good. That's a lot. So that will get a check as well. Then, is it over 10 years old? Yes, it's from the 50s. Improving cash flow? Yes, this also will get a check, although it's similar to the other charts. The consistency is not as perfect as I would like it to be, because why were these numbers flat for 6 years and then we have a huge spike and then now it's coming back down? So that's a little bit confusing. That's the only thing I don't like to see. This is adjusted free cash flow. Here's regular free cash flow. So I mean, it's not bad. It's not a bad chart. It's just I will be worried if they see the revenue isn't that bad. It's the net income and the free cash flow where even the net income is a little bit better. The free cash flow is really the problem of being flat for so many years. And net income, even from 2006 to 2020, it went from 215 million to 350. So not a lot of growth there. That's the only thing that kind of worries me. But we'll see. We'll see what happens. I'm going to keep an eye. I mean, it's just important to pay attention to what their earnings are doing. I'm sure they're going to be, this is if they own 8 different brands, I'm sure they're probably going to buy another brand, or they're going to sell one of the brands they already have. Here we go. This is what happened. Shares are up after a 13G filing showed, okay, green equity investors increase its stake to 5%. Okay, so that's it. So nothing internally to the company happened any differently. So yeah, that's my take on this. The return on capital numbers are incredible. The balance sheet is just fine. Nothing fantastic, but not bad at all. It's the profit margins are good. ROI is incredible, super good. And the revenue growth consistency is super good. The share appreciate, like, let's see, in the last 5 years, the stock's up 136%. That's really good. That's beating the indexes. So the dividend is good. The shareholder return is good. The share buybacks are good. The only thing I'm kind of skeptical on is that free cash flow and that net income either being flat or not being consistent, because that's the only thing. I want a little bit of growth, even if it's like 5% or something a year, 5%, 7% a year, that would be fine. So that'd be the only thing that I'm worried about. But other than that, I would be interested in the stock as long as I don't know if it's going to keep going. It could. The P ratio is cheap, so it could go up to $200, and that would be fine. That would be realistic. But this just looks unrealistic from how. I mean, sometimes stocks do this, but it wouldn't surprise me. I mean, this entire year it's been trading at around $120, $130. So I would think it would come back pretty close to that price, but we'll see what happens. That is my analysis for Williams Sonoma. Thank you for watching, and I will see you guys in the next